Hello friends, welcome to my channel Virtual Learners. In this platform, we discuss numerous topics regarding preparations for examinations like UPSC, SSC, banking, KAS and much more. Today, we are going to discuss about some terms related to economy that appear frequently in news. This is relevant both in terms of current affairs perspective as well as subject related details. Now we will move on to the topic monetary policy. What exactly is monetary policy? It is the policy of the central bank of the country. In case of India, it is the RBI who is dealing with the monetary policy. So, monetary policy is the policy of the central bank, whereas the fiscal policy is related to the policy of the government. Now we look into the details of monetary policy. It is the policy of the central bank of the country based on which actions that influence the country's money supply are taken. So what is the main purpose of monetary policy? It is to regulate the money supply in the market. So it is aimed at achieving macroeconomic objectives like controlling inflation, consumption, growth and liquidity. Now we will move on to how the monetary policy is carried out. It is by modifying the interest rate, buying or selling of government bonds, changing the amount of money banks are required to maintain as reserves, example CRR, SLR, etc. We will take an example. If the interest rate of the loan increases, then the demand of the loan decreases. Or in other terms, we can say that the amount which is lent by the bank will get reduced because the interest has gone up. The same thing with buying or selling of government bonds. If RBI is selling a government bond, then people will purchase it by giving money. So the excess amount of money in the monetary system or the economy will circulate back to the RBI, whereas bonds will be kept with the people. For the third case, changing the amount of money banks are required to maintain as reserves, let's take the example of CRR. In CRR, the amount of cash which is deposited in the RBI can be changed by changing the CRR. So we can take the example of CRR. I explained already that CRR is cash reserve ratio, which means that the amount of reserves that has to be kept with the RBI by commercial banks. So take the example that CRR is 4% and the total amount of money that the bank has is 100. So the amount of money that bank has to lend is 100 minus 4, that is 96. Now if CRR is increased to 10%, the amount of money that the bank has to lend is 100 minus 10, that is 90. So in this way also, the monetary system or the RBI can regulate the money supply in the market. The quantitative and qualitative measures of money control can be detailedly explained in the next video. Here, we will move on to Monetary Policy Committee. This Monetary Policy Committee is the decision-making committee for the benchmark rates that has been published for monetary policy regulations. So, it's simply a committee that decides the benchmark rates. The Monetary Policy Committee was constituted as per Section 45ZB under the RBI Act of 1934. So, it is a statutory body. We will what essentially the Monetary Policy Committee does. It decides the benchmark rates. We have already learned about CRR, SLR, etc., which are reserve ratios, and these are related to the regulation of money supply. Now, what is the composition of the Monetary Policy Committee? RBI Governor is the ex officio chairman of the Monetary Policy Committee. The committee is a 6-member body. Now, we see that there are 3 members from the RBI and 3 nominated by the central government. Decisions will be taken by majority vote, with each member having a vote. Here the governor does not have a veto and he does have a casting vote. This is the gist of Monetary Policy Committee. We have to remember that it's a statutory body under RBI Act 1934. Now we will move on to NPA, that is non-performing asset. What is NPA? It is a loan or advance wherein the interest or installments of principal remain overdue for a period of 90 days. That is a loan which is overdue, and in the 91st day it becomes an NPA. That is, a loan is given to a customer and the customer does not repay and it gets overdue, and that 91st day it is classified as NPA. With respect to banking, we have to note 2 things, that is, one is asset and the other is liability. What is an asset according to a bank? Loans are considered as assets to the bank and deposits are considered as liability. There are three main classifications of NPA. One is substandard, that is other is doubtful, and the other one is lost asset. Substandard assets are assets or loans which remained NPA for less than or equal to 12 months. When this loan, substandard loan, which remains substandard for 12 months, then it is called doubtful asset. That is, if it is NPA for 12 months, it's called substandard asset. When it is substandard for 12 months, it is called doubtful asset. When the bank auditors thinks that the amount cannot be retrieved, it is considered as lost asset. So these are the main classifications of NPA. NPA is very important during the current scenario because NPA is one of the troubles that public sector banks has got now, and it is really a worry to the public sector banks. So this topic is of relevance. We have to study the classifications of NPA and also the criteria for categorizing a loan into NPA. Now let's move on to the topic capital adequacy ratio. What is capital adequacy ratio? It is the ratio of bank's capital to the risk-weighted assets and current liabilities. That is, it is the ratio of bank's capital or bank's funds to the loans which is given. Here the risk-weighted assets means the loans which is given. So it is a measure of capital of the bank which is expressed as percentage of the bank's risk-weighted credit exposures or simply the loans which are given. So CAR is basically capital funds divided by risk-weighted assets. Now we will look out for why CAR is very important. CAR is critical to ensure the banks have enough resources to absorb a reasonable amount of losses before they become insolvent. What is the meaning of this? That is, the amount which is given as loan should be covered by the capital. So how much they can absorb the risk is what is generally meant by capital adequacy ratio. So that ratio determines what is the position of the bank in terms of financial health. Basel III norms actually is an international guideline for banking operations. This Basel III norms stipulates a capital to risk-weighted asset ratio of 8%. But in India, as per RBI norms, Indian scheduled commercial banks are required to maintain a CAR of 9% and public sector banks are to maintain 12%. So this is the criteria in India. The CAR is one of the indicators of financial health of the bank. We already said that. Now let's take the example of XYZ bank, which is a commercial bank. The minimum amount of CAR that is required is 9%. The ratio should be 9%. If it is below 9%, then corrective actions would be followed by the RBI on them. So corrective actions would be imposed by Reserve Bank of India on them because they did not keep the minimum of CAR, that is 9%. Now let's move on to prompt corrective action, PCA. PCA is a banking related term. What is PCA? PCA norms are imposition of certain restrictions such as halting branch expansion and stopping dividend payment. It can even cap a bank's lending limit to one entity or sector if certain thresholds are breached. What is the meaning of this? PCA, as I said, it is a kind of restriction. Who is imposing it? RBI is imposing the restriction. When it is imposed? When certain thresholds are broken or it is not met. Previously, we have studied about CAR. Take the example of capital adequacy ratio. It is stipulated that it should be 9% for commercial banks in India. When a bank does not meet that, RBI can step in and take corrective action against it. This is called prompt corrective action. And what would follow is that the bank's lending limit would be reduced to a sector. It can even halt the branch operation. So that is the corrective action that RBI is doing if some of the thresholds like capital adequacy ratio is not met. The main objectives are, it aims to check the problem of non-performing asset. PCA is intended to alert the regulator as well as the investor if the bank is in trouble. RBI can place restrictions on dividend distribution, branch expansion, etc. as we have already learned. Bank may also not be allowed to enter into new lines of business. So PCA, when it is summed up, is restrictions which are imposed by the central bank if some thresholds are not met. So it is a corrective action by the regulator, Reserve Bank of India. Now let's move on to strategic disinvestment. What is strategic disinvestment? Before that, we will know what is disinvestment. That means selling of stake of government in a public sector enterprise. That is basically selling of shares of a government entity. When it comes to strategic disinvestment, it is a disinvestment which also includes transferring the ownership and control of a public sector entity to some other entity. So disinvestment including the transfer of ownership is what is called as strategic disinvestment. So now we will learn about which is the department which is dealing with disinvestment. The Department of Investment and Public Asset Management, DIPAM, under the Ministry of Finance, has been made the nodal department for strategic stake sale in the public sector undertakings. So how and why it is done? It is done through selling of shares. And why it is done? It is done to improve public finance, and it is surely a revenue for the government for investing in the economy to encourage spending and fund growth, and also for expenditure on social programs like health and education. So government is finding money by selling its stake in public sector entities to private sector so that it can make revenue and expenditure on social programs can be done. So this is regarding strategic disinvestment. If you like this video, please share, subscribe and comment.